To me, one of the most important metrics when it comes to investing is the cyclically adjusted price-to-earnings ratio, or the Shiller price-to-earnings ratio. And I enjoyed the comments here saying how it is an old-fashioned metric, it doesn't work because times are different now. And exactly because of that, I think that it's crucial now to understand the cyclically adjusted price-to-earnings ratio, because we are in a peak cycle moment and therefore we need to know what's going on from a longer-term perspective. The CAPE ratio uses 10-year average real earnings to smooth out fluctuations in corporate profits that occur over different periods of a business cycle. Normality with the economy, with everything, is to be in cycles. If you look at the Shiller PE ratio, you can see these cycles. Life, economies, and everything goes in cycles. And now we are at the second most expensive cycle peak in the history of the US stock market. Each time the Shiller PE ratio was that high, the crashes afterwards were terrible: 85%, 75%, and about 60% adjusted for inflation. Now, from here, with the Shiller PE ratio at 38, with just one 2020 recession, but with zero interest rates, with money printing, everything done to push earnings higher, we have that crazy of a Shiller ratio, lower taxes, everything looks great. Everything looks great, people are willing to pay whatever for stocks that high of a Shiller PE ratio, and that's exactly what leads to double counting when it comes to investing. If we look at margins, keep in mind the cycle. Look, profit margins were around 8%, 9, 10%, and now, given all the money printing going on, now margins are suddenly 13% at historical highs. Consequently, Wall Street's projections are for earnings to go from the 200 that are real earnings, not what Wall Street is saying, to 311. I don't know what Wall Street is thinking. In 2 years, earnings will grow more than 50%. 50% on already higher margins. This is crazy. Like earnings never crash for whatever reason. If we look at the Buffett indicator alongside the CAPE, we see that we are now above 2 standard deviations compared to GDP. And now when you invest and everything is great, great earnings, great growth, great everything, great business, great economy, great high valuations, my question is, from now, things can get only better or only worse. That's the double counting. We have everything great, thus valuations should go lower, not higher, but that's the market, that's Wall Street. They like to double count things and project things always improving when things are good, and the opposite when things are bad. The historical average is 17, we are now at 38, and there were times when the Shiller PE ratio was below 10 for long periods of time, and even during the 2009 crash. So the market will always get too exuberant when things are good and too panicky when things are bad. When those things become bad, you must be here on this channel and spend your money. And yes, everyone is saying this time is different, there is so much money on the sidelines, which is not correct. The pandemic over saving is gone already, so oprosti slobo, ali tako je. There is a lot of exuberance now, and then everyone also expects a V-shaped recovery. People are holding cash. Okay, can happen, but might also not happen. Also, Warren Buffett is old, he doesn't understand. Why is he going to cash? That's why I like the CAPE ratio. Some say 10 years is not enough for a cycle. Some say wrong metrics, generally accounting. Exactly, generally accounting accepted principles are the best to show the real thing, not any other measures, EBITDA or whatever, operating earnings. So I really enjoy the CAPE ratio. I hope you will enjoy it too. And we get two free opportunities in life to buy at the low CAPE ratio. And I know it sounds boring, I know the CAPE ratio is boring, but that's exactly why we need to watch it.